Okay, good morning, everyone. I will call to order the May 28, 2024 meeting of the trustees of the trust funds. Begin by first item on our agenda, the approval of the minutes of the April 17th meeting. Do I hear a motion to approve them?
So moved.
Second.
Any corrections, additions, changes? Hearing none, we'll call the question. All in favor?
Aye.
And the chair votes aye. Okay. The Daniel Street Trust. So you will recall that at our last meeting, after we had approved the disbursement of funds at the request of the city manager for activities associated with veterans last November, that we noted in the trust document that there was a 10-year sunset provision. And what you have in your packet is the email correspondence between Suzanne Woodland and me relating to that provision. And I also supplemented this with a telephone call to her just to clarify. But what she has said, and she points out that she was involved in the entire drafting of this Daniel Street Trust and the negotiation with the Charitable Trust Division and the disbursements that were made. And the trust was originally set up to have two functions. One was that the bulk of the money had to be used for a new project right away. This was for the replacement of the Connie Bean Center, and the monies was used in the Middle Street School project. And then the other was this $20,000 holdback that could be spent at no more than $2,000 a year to celebrate veterans-related activities. And she said that provision, which gave a limit of, or said that if the monies weren't spent within 10 years, that, I should say, the trust was supposed to collapse in 10 years and final disbursements made. That only was intended to deal with the bulk of the money, not the veterans-related activity. And in fact, she said the reason that there's still the amount, 10,000 or so left, is that for the first 5 years, they couldn't find anybody who was willing to make proposals to use the money. And it was only when the current head of the department came on board that he says, absolutely, I'll come up with something, and that's how it's happened. So I'm just reporting that out because I don't think it takes any further activity from us.
Well, I noticed in the trust document, 2 of the 3 trustees are still serving that put it through, so.
I noticed that too.
Yeah,
What was it, 2013?
2013.
13,
Yeah.
yeah.
So the money mostly went to the middle school project.
Yeah,
Well, yes.
for the addition, the Connie Bean Center,
Yes, the addition.
the new Connie Bean Center, on the addition on the
Yeah.
school. So, any questions about that?
No.
All right. So, the next item is, until John gets here, we can sign any checks if you got any.
I don't have
No checks,
any.
okay.
Yep.
No checks.
No checks.
Yay.
All right, well, while we're waiting for John, then we can briefly touch base about the, what's the name of the other trust there that we,
The Haven Metals?
the Heaven Metal situation. So, are you on top of this one? Okay, so we had some email correspondence that Judy forwarded to me, and Peter also, you received.
Well, I got it originally and sent it to Judy
Okay.
from the
Brent
high school
Sullivan, yeah,
council,
yeah.
yeah. So,
So there was, the issue is that the high school guidance department wanted to know if the Haven metals, and this was something set up by Horace Haven in 1834, could be used for the career training program, the CTE program. And what happens typically is we do with other scholarships, we provide that, we tell them at the beginning of the year how much money is going to be available, and then the department makes the decision. Apparently, with the monies that we have, they can no longer give out metal medals, so they give out plastic medals. So we went to look at the documents and realized that there aren't any documents. And so I asked Judy if she could follow up with the legal department, and they can't find anything in their files, but I asked, I don't know if you've had a chance to talk to legal about looking at the probate records over in Rockingham County.
I've made the request, so we're waiting.
Yeah.
Yeah.
So that's, and Bryn's prepared to come down and speak to this, but next week she will have her newest baby, so I didn't want to drag her down here to talk about it. We have something to talk to her about as well, so, but that's just an update, so.
Well, she probably should come in October, because there were a couple other things we wanted to talk about.
Yeah, but the issue here would be if there's something, if we think it's worthwhile opening this up. I guess the issue is the way that the school has interpreted, because they have an outline of the criteria, but no one knows where that came from. And no one knows who created it at the school. It refers to 2021, that if we think it's appropriate, we could start the process of getting a non-judicial settlement going.
Dana, did you ever get a medal?
I wasn't smart enough. Yeah, but,
I mean, there were a lot of categories.
Yeah.
I didn't get one either.
yeah, I think my sister got quite a few.
Yeah.
But if I recall, they're for academic,
Oh, it's all academic.
all academic.
And the school has traditionally, the guidance department has traditionally interpreted that as meaning traditional,
Yeah.
college prep academic courses, math,
Math, English, foreign languages.
right?
So why did they come to us? It's got nothing to do with financial or.
Well, it does, because they wanted to add something.
I understand, but there's no money disbursements from a trust.
Well,
Right.
there's money dispersed to pay for the medals.
Oh, I see.
Yeah, that's what I say, we're not
Okay.
giving out scholarships.
Yeah.
But it's important, I guess, enough to the school that they'd like to extend that to the CTE program.
Yeah.
Where were they getting the money now for the
From us.
medals?
From
Huh?
us.
We have it. So there's a small corpus of money in the Haven
I
Medal
see, okay.
Fund.
I see, okay.
And every year, how
There's
much?
500 for this year, so
Yeah.
they have $500 to spend on.
Okay, I get it. I get
Yeah.
the full picture now.
So we're just talking about expanding the scope
Right.
of recipients. But that would probably require, depending on what we can find for a document, a non-judicial settlement agreement. So if we thought that worthwhile and we could get some documentation, we could start that process in June, and maybe have it done by October.
Yeah.
So, but, all right, so that's,
That's an interesting one.
yeah, little something new every time. So at this point, I guess we just wait till John comes on, unless one of you have something new you want to?
How things with you, Judy?
Busy. Busy, but
Mr.
good.
Chairman, I move we go into recess awaiting the TD Bank.
All right. How do we tell Kevin that we don't?
He's got it, and he took it off. Yep.
That
Thank
way-
I'm doing good, thanks. I ran into several people over the long weekend who, they weren't wearing masks, but they probably should have been, so. Anyway, hopefully nothing serious, Dana.
Yeah, thank you.
All right, for the record, we're coming out of recess, back recording, and I want to welcome you, John DeQuattro, and we anxiously await hearing your report, and we'll give you the floor.
Sounds great, thank you, and good morning again, everybody. Let me attempt to share my screen here. Do you all have printouts of the presentation?
We
Yeah,
do.
thanks.
Yeah, okay, great. I'm going to share my screen, and I've highlighted some things to point out. Please tell me if the presentation came up.
It
It
did.
You did, yeah.
Okay, great. And I'm going to zoom in on this just a hair. So just to kick off, I'll remind you, as I do at the beginning of our meetings, that we have 4 portfolios to discuss. However, they are all managed to the same model. They're obviously all subject to the same investment policy. And so this happens to be scholarship that I put first in the deck. But the weightings of the holdings of the model are all identical for all 4 portfolios, so the comments that I make for scholarship will pertain to all. But specific to scholarship, and this is a review of Q1 2024. So just on the upper left here, you can see scholarship's value at the end of the quarter was $12.4 million. Now, I know you've all seen the the April dashboard report since then. We got off to a great start to the year. For the quarter, we were up 7%. April was, we took about half of that away. April was a down 3.5% performance month. And then in May, we gained it all back, and we're now a little bit ahead of the figures you see here. So, for example, the $12.42 million that you see as a market value at the end of March for scholarship, as of this morning, is $12.45 million. We've added about 0.3% in performance so far in the month of May, and obviously we're just a few days away from concluding the month. So the figures that you see here are very different from what you saw at the end of April, and very similar to what the market values are today. Over on the right-hand side of the page, and if you look at this pie chart, blue and purple are equities, so you can kind of instantly see the asset allocation, 75-25, and then you see a little more granular detail to the table description to the right of the pie chart. And as we go down that list, and it starts with equities on top, overall we are maintaining a 75% equity allocation, 25% fixed income and cash. And as you go down that list, you can see the single largest exposure is the 55% allocation to large cap core, which is specifically an ETF in the S&P 500. I'll remind you, and I'll show you the detail in a minute here, that the model consists of 10 passive exchange traded funds. 4 of those are equity, 6 are fixed income. And on the equity side, as we go down this list, your next largest exposure is to the Russell 1000 Value Trust. And then we have about a 5% exposure to small and mid cap, 5% to international, to developed large cap international stocks. There's no emerging market exposure currently. And then within fixed income, very much predominantly an intermediate bond strategy, predominantly U.S. Treasuries and investment grade corporate bonds, but you can see right in the middle here, just under 2% allocation to high yield, which has been beneficial it's a modest allocation for certain, but it's been beneficial to the portfolio's performance on the bond side, and then about a 2% target to cash. And that's consistent with where the model was when we talked about the fourth quarter of 2023. In the middle of the left-hand side, and I'll go into more detail on this in a minute, inception to date performance, and this is net of fees. Your fees are 20 basis points all in, or 0.2%. So net of fees, just over 5% since inception, and again in the first quarter, 7.13%, and as of today, 7.43%. So it's been a strong start to the year, a stronger start than I think many people anticipated. If you go down to the next section, just briefly, these are your unrealized gains and losses within the scholarship portfolio. You have 1.7 million in unrealized gains, 225,000 in unrealized losses, so a net of about plus 1.5 million in gains. All of the gains that you have in the portfolio are within equities. We are still coming off of and recovering from the dramatic increase in interest rates that started at the beginning of the first quarter of 2022, but very much clawing those back. So we've seen improvement in this statistic for several quarters now. Any questions there before I go to the detailed portfolio holdings?
No, I think we're good.
Yep, okay. I'll jump ahead to page 6. And what I'm showing you here on the left-hand side, these are the actual portfolio holdings. So I won't go through the whole list, but you can see at the top starts with the S&P 500 ETF, and then you see the Russell 1000 value below that, etc. On the far, you'll see in the middle of the column, middle of the page, your allocations. So the top two happen to be the two biggest. And on the far right, you'll see the performance for the first quarter of 2023. And once again, which has been a bit of a recurring theme, the S&P 500 has been the largest contributor performance-wise to the portfolio. Really, any diversification from U.S. large-cap stocks has contributed to somewhat less performance than the S&P 500, but we very much want you diversified across more than just those 500 companies. And keep in mind, the S&P 500 is cap weighted, meaning when you put $1 into the S&P 500, it doesn't get split evenly across the 500 stocks. It's weighted by the size of the companies, and so roughly 7-8 cents goes to Apple, about the same amount to Microsoft, Amazon, etc. So we very much want you to have diversification across just those large tech companies. But U.S. large value had a great quarter as well, almost 9%, and then international has continued to be a drag relative to the U.S., just under 6%, and then you get into the fixed income performance, and despite the fact that we've been in kind of a trading range as it relates to the level of interest rates, in the first quarter, longer-term rates meaningfully went up, and it was really a reaction to the market realizing that at one point the market was pricing in a potential for a Fed rate cut in the first quarter, and it became very clear as the quarter went on and the Fed kind of maintained a more hawkish tone that wasn't going to be the case, so rates adjusted upwards. And so you can see the negative 1.28% that you see with the 7 to 10 year Treasury bond strategy, and then 2 lines below that, the negative 0.84 for your investment grade corporate bond strategy. None of that is a function of those bonds becoming riskier in the market's eyes, purely a function of when interest rates go up, bond prices go down, and the effect is more dramatic the longer the maturity profile. So those happen to be the 2 longest maturity average products within the portfolio. Conversely, if you look 3 rows up from the bottom, you can see the 1 to 3 year Treasury was actually up 25 basis points. And then right below that, the best performing components of the fixed income market were your 2 below investment grade products, 1.45% for the high yield ETF, and then it's 4 rows from the top, the floating rate. So those are bank loans that get securitized, and that portfolio was up 1.6%. So interestingly, the lowest quality from a credit standpoint products in the portfolio perform the best, and that's been pretty true for several quarters now, and it's really a function of the economy's doing better than the markets expected, which is obviously good news for lower credit quality companies, and the spreads that you earn on those particular bonds is much higher than U.S. Treasury or the investment grade market. So that extra spread has more than offset any credit losses in those portfolios. And then just lastly, in terms of performance, I'll jump to page 7 here. And this is the portfolio as a whole. So we were just looking at the individual components. Now this is at the aggregate level. Again, this is as of the end of the first quarter. In the first quarter, and you may remember this from the March dashboard, net of fees, the portfolio was up just over 7%. And we can compare that to the City of Portsmouth investment policy at just under 6% for the quarter. So pretty meaningful outperformance in quarter one. And then I just highlighted at the bottom of the page since inception, kind of a similar level of outperformance, just over 5% for the portfolio, 4.29% for the allocation in the IPS. And the reason for that's really simple. Relative to the investment, the portfolio is overweight U.S. large cap. So that 55% allocation that you saw to the S&P 500 is about 5% higher than your IPS. And the portfolio is currently underweight international by 5%, or emerging market by 5%. We actually have no emerging market in the portfolio today. And then the policy also has a 5% allocation to REITs. And we don't currently have any REIT exposure. So that tactical weighting has benefited the portfolio, and not recommending any changes today. At some point, we'll see different numbers here because international developed Europe in particular looks pretty reasonably priced relative to the U.S., but the market just hasn't been rewarding them. The U.S. economy definitely has been performing stronger than Europe, not by multiple percentage points, but sufficiently enough that it's where the market sees better growth right now. But that'll change, and over time we'll make some tactical adjustments. But for right now, I'm not recommending any changes to the portfolio, and it's doing quite well. With that, I'll just point out to you that within the deck here, we've got these slides for the other 3 portfolios, but I won't repeat my comments there again, exact same model. But I've got the investment overviews for you for the other 3. Any questions there before going to the economic update?
Dana?
No, good.
Peter? No? Looks like
Okay.
we're good.
So just really quickly on page 14, these are the returns in the first quarter of the major market indices. So we have bonds on top, equities on the bottom. And I just highlighted the U.S. aggregate bond index. So this represents the entire U.S. index of investment grade bonds, mostly treasuries. It's got investment grade corporates. It looks a lot like your bond portfolio, except it would have more asset-backed securities, mortgage-backs, et cetera, and a slightly longer duration profile. But to my point earlier about bonds being down in the first quarter, you can see the aggregate U.S. bond index was down just under 1%. Similar to your portfolio, at the bottom of the fixed income table, high yield outperformed. Again, you're just getting a much higher coupon rate on those securities. And that allocation has benefited you. And then here in the equity section, again, 10.5 for the S&P 500, and very consistent with our updates over the last really 4 to 6 quarters. U.S. large-style growth equities up 11.4% versus 9% for value. And I'll talk a little bit more about that in a couple of slides. We have, for the first time in quite a while, started to see value catch up and growth take a breath here. You don't have, you've got a 10% allocation to value, but in my mind, that's not so much an overweight to value as it's kind of correcting the fact that the S&P 500 has a bit of a growth overweight, as I said, because the technology component has done so well. And then international, right below that, again, you can see, continues to lag the U.S., but valuations there continue to look compelling. So, we certainly want you to have a modest allocation there, but we are 5% underweight to the IPS. With that, the next 2 slides speak to fixed income. Boy, I don't think in the last 10 years have I had a slide so dated as this one in such a short period of time. But what it's showing you is, so this is just a prediction, the market's pricing in of what the Fed's going to do. And so if you go to the far left here, it's just comparing two different periods in time, forecasting what the Fed funds rate's going to do. So green is at March 18th, 2024, and gray was at the end of 2023. So going into the year, there were some expectations for as many as 7 rate cuts over the course of the year. And again, this was on based on both the Fed's own forecasts and the commentary that they're giving us. By the end of the first quarter, that had dramatically changed by over 100, or by 100 basis points, and now, essentially 2 months later, TD has cut its forecast to 1 rate cut for the rest of the year. And that is a function of the next slide here. Sorry, let me shrink that a tad. On slide 16, so this is inflation going back to 2019, 2 different measures of inflation, CPI, which you most commonly hear quoted, the green line, and then core personal consumption expenditures, PCE, another measure of inflation and price pressures, slightly different basket, and then the red dotted line is what we refer to as the Fed's stated 2% target. So you can see, the dramatic increase in interest rates that the Fed started engineering in the first quarter of 2022, always a lag effect, but has been successfully doing its job up until really the first quarter of this year. And we've had just, the term most often quoted is just stickiness. We've had kind of the 2 biggest components in there has been owner's equivalent rent, which is how housing costs are incorporated into CPI. Auto insurance has been dramatically higher, and that's largely been a function of kind of the price pressures that occurred on automobiles during the pandemic, everything getting more expensive, and then sort of the lag in the regulated insurance companies adjusting their premiums. And so here we are just kind of dealing with the fact that the service industry was so dramatically shut down during the pandemic, and now, is very much unaffected. And so here we are. So this is what's led the Fed to really kind of put a hold on any immediate decrease in interest rates. Ironically, and this is something we could spend the next 2 days talking about and not coming to a definitive conclusion on, but several people are discussing the fact that at a point in economic history when the government's debt is 130% of GDP, the argument could be made that there are so many Treasury securities in circulation now that the increase in interest rates, which is intended to slow down the economy, could actually be stimulative. And then the simplest way to think about that is, 2 years ago, if you owned a 10-year Treasury, you were getting hardly any income at all. You're now getting, about 4.5%. Well, that's a pretty big pay raise for, any segment of the economy that holds these Treasury securities. So I would say there's no doubt that has been a factor in, and I highlighted the commentary down here, the resilience in both domestic demand and labor market have stymied the previously favorable downtrend in inflation. So, could we be in a situation where the Fed's attempts to slow the economy are actually having the opposite effect because of the massive amount of interest that's being paid on the treasuries out there? I think that's definitely a factor, but there are so many variables as it relates to CPI, it's really hard to isolate any one. And then to the equity market, this is a really interesting slide. So what it's showing you, it's a little bit dated, but the point remains. This is showing year-over-year earnings growth for the S&P 500, but it was for the fourth quarter of 2023, so at the end of last year. And what it's showing you is that 60% of the earnings growth of 500 companies came from 7 companies. And this is what the financial press has been referring to as the Magnificent Seven. You can see them listed at the very bottom of the page in the footnote. You'll know all these companies: Apple, Microsoft, Alphabet is Google, Amazon, Nvidia, Meta is Facebook, and then Tesla. And so, those 7 companies experienced 60% annual earnings growth quarter over quarter at the end of last year. The S&P 500 as a whole, in the middle of the page, 4.5%. And if you take out those 7 stocks, the S&P 500 earnings actually declined 5%. So just a dramatic concentration in these phenomenally successful, what we call mega cap tech companies. And, it's true earnings growth surrounded or combined with tremendous euphoria around AI and the potential for that technology. So this type of concentration in the markets historically has been reason for caution. More broadly, you can go back to the NASDAQ at the end of the 90s into the early 2000s. Financial service companies in the early 2000s, if you think of the housing bubble, financial companies started to comprise almost 30% of the S&P 500. Those periods in market history have tended to correct themselves. And again, it goes back to my comment of why I want you to have some diversification away from just the S&P 500, and you have that within the portfolio. We started to see this trend change in the first quarter. And you can see that on page 18. So this is a little more timely. What we're showing you is on the left-hand side, you see the S&P 500, really the U.S. economy, broken out by sector. So technology, consumer discretionary, communication, etc. The gray bars are the sector's contribution to all calendar year 2023 performance, and then we're comparing that to the first quarter of 2024. And if you look at the green lines, you can pretty easily see we've had a much more balanced contribution across the sectors in the first quarter. That's a good sign. It's a sign of, greater market breadth, more companies participating in the performance of the market. And even though here you're seeing technology still be the largest driver of returns, that's actually consistent with the segment's concentration within the S&P 500. So technology is about 28% of the S&P 500. But again, a broader concentration across the sectors. And then just lastly on this point, in the first quarter, Apple trailed the S&P 500. Apple was actually down for the quarter. So in a quarter where the S&P 500 was up 10%, Apple was down a little bit. Tesla was also down more significantly. And Google actually trailed the S&P 500 in the first quarter. So again, we like this in the context of a healthier contribution from all sectors, but also interesting to see, has technology potentially peaked here for the cycle? Too early to tell. But again, we're not taking we're not trying to hit grand slams in your portfolio. You've got meaningful diversification, so you're well positioned regardless of kind of whether this trend continues or not. With that, just one brief slide here, kind of topically on REITs. And as we talked about earlier, your policy allows for, or actually has a target of 5% allocation to REIT. We have tactically avoided REITs for kind of the reason you see here, which has really been the trend in particular, really all sectors except retail have experienced rising vacancy rates, and that's what you see represented graphically here, with the most struggling sector being office, which, as everybody knows, is dealing with the aftermath of the pandemic and the work from home and now hybrid work environment. We're seeing instances of commercial buildings being converted to housing, which makes a lot of sense in terms of just the overall demand of housing versus commercial office space. However, it is really expensive in many cases to do those conversions. The buildings largely weren't designed for residential use, so it kind of takes these buildings, you'll see these buildings sold at auction for, in many cases, pennies on the dollar, and then the math works to put the money into changing. But that's definitely a longer-term trend, so we don't expect to see this office segment reverse anytime soon. But it will, and again, as markets go, the sector will get cheap enough that we'll see REITs outperform at some point in the future, but we don't think they're there yet. And then I haven't shown you a slide like this, I don't think, before. So this just speaks to, hey, how should we be thinking about the markets with respect to the coming election? And quite simply, do we want a Democrat for market purposes? We'll leave the politics out of it. Do we want a Democrat or a Republican in the presidency? And so this goes back to FDR, and it's showing you the S&P 500 returns for each president in office. And if you just look in the middle here at the top, you can see that the markets were up in the vast majority of cases, regardless of who was in office. However, the Democratic average exceeds the Republicans by a little over 4 percentage points. TD is fairly agnostic about this. We don't think there's really a connection here between political party and market returns. Again, we sort of support the long-term growth of the U.S. economy over time. And I just point out on this chart that you got a couple, if you look at the two outliers, which is Clinton's 26% return and Bush's nearly 5% decline, President Clinton clearly benefited from the tech bubble and leaving office before it busted, and George Bush inherited that. So if you kind of normalize the chart for the outliers, the averages would actually look pretty darn close. And then just 2 more slides here to walk you through. This is the TD forecast that I put into every chart. This is already dated, as I said earlier. This had already been updated once, where we had significant cuts priced into this year. When this was printed, we had 2 cuts priced in, and we're now down to 1. We don't know. The Fed, even the Fed, who sets this rate's own forecasts, don't come to fruition. But the point here is we've seen both the inflation rate tick up a little more than anybody expected in the first quarter, and the employment outlook has stayed really strong, and we've seen levels of spending that we didn't quite predict. And so, it's definitely going to cause the Fed to hold off on cutting. And then at the bottom left, you see our GDP forecast for the year. This isn't like going gangbusters type GDP growth, but still exceeds what we're seeing internationally for the most part. And we seem to have avoided a recession here, which is pretty impressive considering the economic dislocation that came out of the pandemic. And then my last point here on our forecast is we still think it's going to take close to a year and a half before the Fed does get inflation back down to that 2% target. CPI is really, really tricky to forecast. So, I don't expect these numbers across the next year and a half to necessarily play out, but it just showed the difficulty of getting inflation back down. And then my last comment is just I wanted to leave you with our asset allocation positioning across the markets, and this is consistent with the comments I've made thus far. But within fixed income, because we do have a somewhat cautious outlook for overall GDP growth, we do have a quality bias. We don't want clients reaching for yield here. You do have that very modest exposure to high yield, but we do have a preference for just higher quality within fixed income. So that's investment grade corporates and U.S. Treasuries, and you do have that reflected in your portfolio today. And then on the equity side, for more conservative investors, we're kind of focused on dividend growth strategies, and you do have that 10% weighting to the Russell 1000 Value Index, and then, as I said before, a preference for U.S. over international developed. And I don't see that changing over the next quarter or 2 anyway, but again, there will come a time when we want to get your international exposure closer to your policy targets. And that was all the comments I had for today. Just another strong quarter, another good start to the year. We remain at these levels today. Hopefully the month of May will finish strongly, and not recommending any changes to the portfolio.
Great.
As always, happy to answer any questions.
Thank you very much.
Actually,
My pleasure.
let me ask you a question at each of these little sessions. I understand you're not recommending any changes to the portfolio. Do you recommend any changes to our investment policy at this point?
No, I review it ahead of all of these calls, and none at all. No, you allow for a nice range of percent allocations across the various asset classes. There's nothing that you're excluding that I would want you to add, so no changes recommended to the policy at this time either.
Okay. No change in the 75-25 equity to debt?
No, it's funny, we, somewhere on this page, I took it off, but on the page, the very last page I was just speaking to, for portfolio preference, we actually put in there tilt favoring bonds over stocks.
Right.
And so, that comes from an expectation that we think that particularly in the U.S. stocks may have gotten a little ahead of themselves. But that's very much a short-term tactical thinking, which in the context of your portfolios, which are essentially perpetual trusts, it would take a pretty dramatic change in the economic outlook for us to think that changing that target would benefit you significantly over time. And as I said, when you look at how the portfolios have performed either from inception or in the most recent quarter, the story's the same. All your returns have been coming from equity, so that allocation has really benefited you.
Great. And I have a question on the REITs, looking at the chart on page 19, which is the vacancy rates.
Yeah.
I'm curious, just an observation that in the last year, the vacancy rates for retail have dropped below everything, including industrial. So it is, we've been hearing for years about how the internet is causing storefronts to go empty. Has that long-range trend? Excuse me. How do you read these vacancy rates?
So as it relates to any analysis like this, there's a concept called the base effects. And what that refers to is, you hear it most commonly as it relates to CPI, where because these are always year-over-year comparisons. So if the prior period either had an exceptional bump or decline, by virtue of that year-over-year comparison, you can get some figures that look outsized or trend changing, and you kind of always have to think about it in context. I think that's a little bit of what's going on here. I'm looking at the slide up to the screen here, but if I look at 2021, a year into the pandemic, retail had increased pretty dramatically, but then in the opening of the economy, even though I think you're absolutely right about trends in retail, the pandemic shut everything down, and then things have kind of opened up again. And so things got really bad for retail, and it doesn't take, even if they stay flat, which is kind of what the trend looks like, maybe slightly down, because of that year-over-year base comparison, I think that's what's going on with the retail more than any change in the macro trends that you mentioned.
Okay. Any questions of John?
No? Good.
It's been great, John. Appreciate it.
Oh, it's my pleasure. We'll look forward to getting the May dashboard out to you early, hopefully by the end of next week. And hopefully you'll see figures there, as long as the market holds up there the rest of this month, pretty consistent with what we just described. And I will look forward to a Q2 update in the near future.
Excellent.
Great. Thank you, John.
Enjoy your day.
My pleasure. Take care,
Thank
everybody.
you.
Bye-bye.
All right. Anything you want to comment on this sheet?
Nope, so just being clear, just want to be clear again, so that when I write this, and make sure for the AGs that there was no recommendation for change and that the trustees agree with keeping things the same as they were.
Yeah.
Okay,
That's why I asked that question.
yeah,
On
okay,
each of the calls, just
Yep.
so it's in the record.
yep.
All right. Any new business? I don't see anybody from the public, so we won't have any public comments, and so I will entertain a motion to adjourn.
So move.
Second.
Any discussion? Hearing none, all in favor?
Aye.
All right.
Unanimous. Thank you very much.